The third group is this free trade zone JVs. I don't know if any of you have heard, but some entities such as HSBC and BEA, some of the big names that have recently signed agreements to launch free trade zone joint ventures in China. And these differ to the original JVs in the sense that they are, I guess, number one, limited to free trade zone locale, but also the licensing restrictions are fairly different to what the original JVs had imposed on them at the time. So if you look at this slide, you're basically breaking down this China securities market operating income. So this is the revenue pool available in China at the moment. And what you have is, for those of you who are wondering, only 9% of the actual fee pool available is to, I guess, primary market activity, being financial advisory and underwriting and sponsorship. So the vast majority is actually outside of this space, and that's why when you look at what the joint ventures, the space they're actually playing in, it is a very limited subset of the China securities landscape. And I guess this feeds into the story around cost-to-income ratios. You're seeing that the overall CI ratio of the JVs was almost 90% in 2015. It has come down since about 100% in 2012, but it's considerably higher than the top 8 domestic securities houses, which are more in the 50 to 60% range. So it does call into question a different kind of business and profitability model that the JVs have had in recent years. And I guess all of this feeds into, I guess, what is the net profitability of the joint ventures. And as you can see from this slide, it's a very mixed and inconsistent picture. It's not something that has seen linear growth over time. I'm sure you're seeing, especially in this diagram, 2015, especially for UBS, a big bumper year. But again, we have to remember 2015 was a big bull run, especially in the secondary market, where you saw a big blowout in turnover, which really bolstered a lot of the revenues for these firms. But overall, it was a more decent year, and as I was saying, this is much more of an inflection point for JVs to reassess where they are right now and to work out what next steps are in terms of moving forward.
So Ben, I mean, the figures and the data that you presented, I think it paints a very clear story on the JV's profitability and some of the operational challenges that they've been going through. In your view, do you think that that explains why the list of the JVs, existing JVs, and also the upcoming JVs is still just a fraction of the players in the market? And also, for players whom we haven't seen the name in the data, what's their China strategy?
The recognition that it centers around, one is the macro story of China and the broader opportunity, but I guess beyond that it really is around the liberalization of the economy, and I think people are now placing their long-term bets on where China is going to go, and there have been plenty of signals to the market that it is opening up and that the opportunities for foreign players will be there if they play their cards right. We want to talk about the big macro story. Even if you're looking at Dealogic data here, this is looking at the core IB fee pools, especially if you look at the growth since 2013. It's 2.5-fold growth in the actual core IB fee pool. A lot of that is driven by ECM, but that's plateaued out. You're seeing huge growth in the bond markets. This is especially as Chinese banks struggle to extend their balance sheet. NPLs are becoming an issue. So Chinese corporates are looking to alternative source of debt financing, of which DCM is a natural alternative. And you've also seen the M&A fee pool grow substantially. I think we all know that the China secondary market is absolutely explosive. 2015 was quite an anomaly, of course, given some regulatory announcements and changes that really caused a spike in activity, one of which, I guess, was the Stock Connect initiative out of Shanghai. But even 2016, which is, I guess, a normalized turnover year, the total turnover in Shanghai Shenzhen stock exchanges is more than 1.6 times total turnover of the rest of the countries in Asia Pacific. So the overall story is obviously very compelling. I'm quite cognizant of the fact, and I'm sure there are some callers who are dialed in who will say, yes, it's predominantly retail, and that is true. Maybe 85–90% of that flow is retail driven, but even if you strip out that institutional component and look at the growth rate there, it is something quite phenomenal. A lot of the global banks have chosen not necessarily to build their onshore capabilities, but they've really ramped up their A-share coverage out of Hong Kong. So just before Shanghai Connect was launched, most firms, save for UBS and Goldman that had onshore brokerage, were covering anywhere from about 5 to 15 A-share stocks. That's all they had covered. Now all the tier 1 firms are north of 150 to 200 stocks being covered out of Hong Kong. And if you look at the growth of the institutional asset management space in recent years, it's actually grown by a factor of 4-fold in the past 4 years as Chinese institutions, hedge funds become more sophisticated and as savings moves from deposits to managed funds, as just the institutional savings market develops quite rapidly. And this is giving rise to huge opportunities. You're seeing regulation support it, mutual recognition of funds. You're seeing MSCI inclusion, which is on the cards. I guess no one really knows when that will actually happen. But again, there are a lot of signals being put out to the market that show potential explosive growth rate in the institutional space. I mean, overall, you are seeing greater industry consolidation. 125 securities houses at the end of 2015. 2016, that dropped to 109. Also having, I guess, all the existing JVs regrouping for round 2. So as we mentioned before, Credit Suisse announcing an intention to go up to a 49% stake and launching their Shanghai brokerage operations. JP Morgan actually announced a while back it intended to sell its securities joint venture stake. Again, we don't think this is a signal of the fact that they're not committed to China. They have made it very clear that they are committed to China, but as we saw in the past with examples such as Morgan Stanley and CICC, there are sometimes some strategic impediments to making these JVs work. So finding an ideal partner is obviously part of that process. And Morgan Stanley's re-entry back into the market was indicative of the fact that its exit from CICC was not permanent. And you're also seeing UBS and Morgan Stanley also have raised, I guess, their hands to signal intent to go up to 49%. Again, I think if you look at the strategic rationale to go from 33 to 49, not too much. But what it would say is if you're going to 49, there is a tacit understanding that 51 will eventually become available to you. So I think there is a long-term bet and option play that the market will open up, that the foreign banks will be able to get full management control, and that the game with China and what it means for the bottom line of these global firms is going to change significantly. For existing, it really is around a full strategic review. As we've gone through in this presentation, it's quite clear that a lot of these firms have hit some brick walls in terms of achieving some meaningful bottom line profitability. I think a lot of it especially stems from the inability for the JVs to interact cleanly and effectively and seamlessly with the offshore entity. And if you look at the key strength of a joint venture platform with the foreign bank, it is that connectivity with the international network of the foreign partner. Now, in order to make that happen, in order to monetize that, you need the right governance structures, incentive frameworks, training, awareness to really identify deals that they can refer between the entities. With the free trade joint ventures, it really is around appropriate growth planning. You have a firm like HSBC coming in. HSBC is not, in our view, a typical competitor to a Goldman Sachs and a Morgan Stanley. Its advisory strength is not as large, but it does have a very strong DCM capability. It has a very strong corporate banking franchise. And I think from the perspective of a franchise like HSBC, much more emphasis on looking at where are its key strengths and where are the pots of gold that it effectively wants to chase. That will primarily be driven by debt. And the same thought process needs to be done with any firm looking at it, which is really around assessing the market opportunity in a much more granular fashion beyond the high-level fee pools. We know Dealogic, you guys have enough data and firepower to be able to break down those fee pools into, the kind of enterprise bonds or corporate bonds, whatever SME bonds, to understand in which field do these firms feel they can play and where do they have their strengths to really capture meaningful market opportunity. So it really is understanding of the product set, the client set, and I guess the inter-China geographic focus. And I guess the final one is the Aspirant JVs, and this is really around market entry assessment. Should they even consider entering? And I mean, we know from our discussions that some Malaysian players, potentially some Taiwanese players, they've had this in the back of their minds. And again, it is identifying, you know, what is it that you effectively want to achieve from entering China? Is there some kind of cross-business connection, cross-border connection that you can see that another bank doesn't have a natural foothold in? And the most important thing for these aspirants is, what channel are you going to go through? Is it really your free trade zone channel or your traditional JV channel? And if so, the partner selection. And again, we've learned from, I guess, a brief history here, although it's quite light, that selecting the wrong partner, in inverted commas, can potentially lead to a dissolution of a JV down the road.